I want to explain to you briefly what an income statement is, what a balance sheet is, what a cash flow statement is, and how all three of those financial statements are connected so that you can enjoy completing this section. Okay, so let me kick it off with the income statement. Okay, so and when I explain this stuff to you, I want you to kind of think about what if these statements didn't exist? How would we keep track of all of the stuff we own, the money we make, the money we owe? Okay, so it's actually a really brilliant process. So let me start off with the income statement. Okay, so like I mentioned earlier, the income statement at the top is your revenue, which is also called sales. And sometimes you hear people say, what's your top line growth? And basically what they're saying is, what's the growth of revenue or sales? And like I said earlier, sometimes you'll hear people say, what's the bottom line? And what's your bottom line growth? Well, at the bottom of the income statement is net income, your profits. That's your bottom line. And so what happens is the income statement, it's kind of like when you file taxes. The income statement is the easiest statement to understand. And all it does is it basically calculates the cost, how much money you're making minus all the expenses. Okay, so you can understand what the bottom line is, what the profitability is. Okay. Now, does that mean that after we take revenue and we deduct all the expenses, meaning salaries for people, cars, whatever it might be to run our business, does that mean if we take all those expenses deducted from revenue that we know how much more cash we're going to get in our pocket? No, because the income statement's kind of a lie, and I'll explain what this means. So what happens is governments, from an accounting perspective, don't fall asleep on me. From an accounting perspective, governments, what they do is this. They allow you to depreciate certain items over a long period of time. And I'll explain what this means. And this will make a lot of sense why we have the cash flow statement, but we're still in the income statement part, okay? So let's say that you wanted to buy this, okay? And this costs a lot of money, okay? This is pretend, by the way, but whatever. And what the government does, it allows you to finance things or buy things and then deduct how much you use of this every single year. Okay, it's called depreciation. So let's say that you bought this for $100 and this will last you 10 years. Then every year you can depreciate or expense 10% of this, okay? Every year. Okay, so $10, that's 10% of $100 every year. And the reason that depreciation is awesome is because it allows you to pay less in tax, because you treat depreciation as an expense, even though you're not paying cash every year for this. You already bought it, okay? I know it's a little bit elusive, but the reason that governments do this also is they want you to always have the best equipment and the newest equipment. And so they kind of entice you to buy new stuff, and it helps the economy too. And depreciation is different for all products. Okay, so in most countries, when you buy a computer, you can depreciate that over 2 years. When you buy software, you can depreciate that over 1 year. Okay, so that's enough on depreciation when it comes to buying products. There's also something else which is way outside the scope of this course, which is amortization, right? So if you buy a company and you pay a big premium, then the premium that you paid can be amortized or deducted each year. That's not a real cash expense. Okay, good. All right, so now that we understand the income statement, and by the way, when it comes to financial ratios, just stay with me and watch the next couple of lectures, and I'll explain how the financial ratios are calculated and exactly what they mean. Okay, and I don't want you to please ever memorize accounting and finance. I want you to understand it, because if you understand it, then it's a lot more fun. And if you understand it, then you'll remember it forever. Okay, now that I explained what an income statement is, and I explained how when you take revenue and you deduct all the expenses, the profitability doesn't mean the increase in cash in your pocket each quarter or each month or each year, because depreciation is a non-tax expense, for example. So what happens is we look at what's called a cash flow statement, right? If the income statement's a lie and it doesn't tell you really what the change is in your cash in your pocket every month or every quarter, every year, then the cash flow statement corrects it for you. It tells you how much additional cash you have in your pocket that hurts each financial period. Okay, good. Now that we understand from a high-level perspective what an income statement is and what a cash flow statement is, let's quickly talk about the balance sheet. So, how do we keep track of what we own and what we owe, meaning debt? How do we do that? Well, it's not in the income statement. The income statement just tracks what money, what your revenue and expenses are, and the cash flow statement just tracks, how much cash you're getting in your pocket at the end of each period. A balance sheet will tell you exactly what you own and what you owe. Okay, so let me, I'll use a different example this time. Okay, I'll use this badass one here. And I'm not going to peel off the stickers because it says DELL, which I think is another company. Okay, copyright infringement. Just kidding. This is pretend. All right, so on a balance sheet, and everything that you own, everything in this world is either owned by you, a bank, a government entity, or somebody else. And so a balance sheet will tell you what you own and what you owe, okay, and who owns your stuff. And it's called a balance sheet for a reason, okay? And I'm going to humbly challenge you in a loving way to think about this a different way, okay? So a balance sheet has two sides, okay? It's got stuff you have right now and who owns your stuff. Okay. So stuff that you have in your possession, that you own, is called assets, okay? This is an asset, okay? So let's pretend that you paid $100 for this, okay? And it was really expensive, so you got a loan for half of it, okay, from a bank. Okay, so you have this $100 asset on one side, but now you've got 100 here, and the other side of the scale, the balance sheet, is not balanced. Well, on the other side is who owns this, okay? So because it's $100 and you have it here as an asset and you only paid for half of it, you only own half of it. That's called equity. Equity is something you own. So you have $50 in ownership of this $100 thing. It's still not balanced, okay? And the other part is liabilities. You got a loan for it, the other $50. Okay, it balances, good. $100 is the asset on one side of the balance sheet. The other side is $50 in equity you own of this and $50 in a loan, meaning you owe somebody else for it. It balances, okay? All right. And as we walk through your financial statements, this will make a lot more sense to you as well. Anyway, I hope you enjoy the next couple of lectures. I spent a lot of time putting this financial model together for you based on stuff I've learned working on Wall Street and starting companies, etc. And I made it as simple as possible so that there's just one point of entry, the IA button, and then all the other stuff is automatically created for you. And this is really powerful, especially when it comes to putting your entire business plan together, which we'll do very, very soon. Thanks.